Now we come to the part of the show where I discuss what I believe is important for individual investors to consider before they make their investment decisions. Three things to consider as we always discuss. First one, as you can see on the screen here, economic data and Fed speak. We're actually hearing the Fed, Jerome Powell, head of the Federal Reserve, speak right now. He's providing testimony on Capitol Hill, talking a bit about what he sees with respect to inflation and interest rates, and he'll be speaking on Capitol Hill tomorrow as well. Quarterly earnings takeaways. We just pretty much finished quarterly earnings season. There are a couple of big cap tech names I think are quite important that are going to report shortly in the next day or so. Broadcom, Oracle. But for the most part, we've seen a pretty strong corporate earnings season for the last quarter of last year. And here we are, beginning of March. So we only have a few more weeks left, and we'll soon be talking about the first quarter of this year. So we'll touch on some earnings takeaways and looking at investment ideas in different ways. We talk a lot on the show about being a contrarian investor. Well, not so simple just to buy those investments that are cheap and buy when others are fearful. You have to take a look at those investments closely, look at them from different angles. And we'll speak about some of the different angles and how to look at some of these investments. It's why it's not so easy just to buy the cheapest name that you can find out there. So let's move into the economic data and Fed speak. The first point that I want individual investors to consider before they make their investment decisions, and economic data that I want them to focus on. As I said, Jerome Powell on Capitol Hill right now, testifying in front of Congress, talking about what he sees regarding when interest rates could be lowered, talking about inflation and answering all the questions that politicians have. But soon after, we're going to get a jobs report out of the US and Canada. We'll get that this Friday, jobs report. We know that the jobs data out of the US was actually very strong last month. We have a chart that will show you that. Grew 353,000 jobs for the month of January. So it's a big number. There it is. A big number coming out. We saw December actually report almost as strong a number. So the February number will be key. I know the Fed really looks at jobs, and in my opinion, I don't think they will consider cutting rates until they see a little bit of softness in the jobs data. Next week, we're going to get CPI, inflation data out of the US. And again, obviously a huge number for the Fed to consider before they decide whether they want to cut interest rates or not. Before we get to that, actually, we have an interesting chart I wanted to show all of you and that love the tech space, and we talk tech all the time. It is talking about technology jobs. So before we move away from the jobs front, we can show you this chart, which is quite interesting. Newly listed U.S. jobs in the AI space, IT jobs. And we were talking off air before this, how times have changed, right? For those that are looking for jobs in today's world or the world of the future, you're going to have to start looking at a lot of AI jobs, artificial intelligence versus IT jobs. Both of them obviously still good areas to be in, but artificial intelligence really starting to rule the day. And again, keeping with the unemployment rate, again, I think we actually have one more chart, which I find quite interesting. And this is a chart which shows us Canada broken down by province, where you see the highest unemployment rate. And my main takeaway from that is you tend to see higher unemployment rates in the Maritimes. You can see they have the highest rates. Lowest rates are in the prairies, Manitoba, Saskatchewan, and our province here in Ontario, about 6.2% unemployment rate, and actually moving higher. On average, you tend to see about a 7% unemployment rate in Ontario. We're slightly below that now, but if you look at where the unemployment rate has come from, we're starting to tick higher as we move along. And the unemployment rate in Canada has gone from a 5% unemployment rate, as I mentioned in my interview with David, to 5.7%. So unemployment is starting to rise, and that is perhaps helping bring down that inflation rate here in our country. So getting back to inflation, we're going to get a CPI number out of the US. We focus on the US often because a lot of the economic data out of the US matters more for the stock market than the Canadian data that we get usually right after it matters for the stock market. And that includes the Toronto Stock Exchange. The S&P 500 will move with inflation data, jobs data, whereas the TSX doesn't tend to move with the Canadian data. It actually moves also with the US data. So inflation numbers will be important, and we'll get a week after that. So in the next 3 weeks, we will get a meeting. Jerome Powell, the Fed, will meet to discuss the recent or the latest interest rate policy from the Fed, and that will come about a week after CPI. So in the next 3 weeks, you're going to get jobs, you're going to get inflation, and you're going to get an interest rate decision from the Fed. We actually received an interest rate decision from the Bank of Canada earlier today, 9:45 this morning. They held interest rates as is. They indicated again that they're pausing. We don't anticipate an interest rate increase, but we do anticipate a decrease in rates at some point down the road. Inflation in Canada, 2.9%, the headline number. As you can see on our next chart, inflation in the US actually coming in at 3.1%. That's their headline number. And core, which strips out volatile food and energy, that is still at 3.9%. So the hope is that we could see US inflation at their next reading under 3%. Hopefully we can see core in that 3.5% range. And I think those are important numbers, along with jobs and a lot of the other economic data and announcements out of the Fed. Those are very important to consider before you make your investment decisions. Second point I wanted to highlight are quarterly earnings takeaways. And we had obviously a pretty positive quarterly earnings season. Most companies beat expectations, the expectations from analysts. And usually we tend to see a beat on the expectation somewhere in the vicinity of 70 to 80% of the companies beat expectations. So they basically do better than what was anticipated of them. But in my opinion, the main takeaway, and as I wrote on the as for one of the points, was quarterly earnings takeaways. The takeaway for me this quarter, or this past quarter's earnings season, was that even though things are going well, they are slowing. There's no doubt about that. So even companies that said things are going well, they also said, however, things are slowing down as we look forward into the future. We're also seeing companies report beats on their top and bottom line, so better revenues, better earnings per share growth, but not as good as they were a few years ago. So definitely seeing a slowdown in corporate earnings and in some cases revenue as well. Perhaps the only exception is the tech space and the artificial intelligence area of tech. Those companies just seem to be knocking it out of the ballpark on a quarterly basis. So first chart I have for you, actually, which is a pretty good example, is a chart of Target, a US retailer. Target came to Canada for a short period and then left recently. So they are a US retailer now, and they provide, toys and clothing, you name it, electronics, pretty wide range of goods. As you can see here, the day that they reported earnings were fantastic. Stock went up almost 13%. It's actually gone up a little more since then as well. But Target was interesting. Even though their earnings for the previous quarter were so strong, they said going out over the next year, they anticipate some softness. And it may not be until towards the end of the year that they would see some strength or increased strength once again. So again, another company saying things are good, but things are slowing down. Our next chart here we have of the Canadian banks. It's an ETF, the Hamilton Enhanced Canadian Bank ETF. And you can see here on the far right, bank stocks are moving higher again. Corporate earnings season, Canadian banks just reported in the last few weeks. And with the exception of Bank of Montreal, pretty much all the earnings were a success, beating on the top and bottom line. And interesting enough, when you look at whether it's Royal Bank or TD Bank or CIBC, their earnings that they reported this quarter were good, beat the expectation, but were not as good as what we've seen in the past. So once again, beating perhaps in with respect to the banks, maybe a bit of a low bar that was set for the banks. So they came out on top, beat the expectations. But once again, with keeping with our theme of things slowing down, bank stocks not making as much as they did a few years ago. S&P 500 chart that we have for you now, which shows that, yes, the S&P earnings per share has been going up since we reached the bottom in 2020. 2021 was a peak. We came down in 23, came down in 2022, and we went a bit higher in 2023 again, but we have never gotten back to our peak in 2021. So once again, things are good, but still not as good as they were. And we've seen a slowdown with respect to earnings. And in my opinion, that is the fear. The fear is that earnings from these corporations will not get back to 2021 until perhaps central banks start to cut rates. The fear is that things will continue to slow, and a lot of people worry that central banks might be too slow in cutting rates to stimulate. And if that were the case, or if that is the case, then perhaps we move into some sort of mild recession. So always the fear from investors that the central banks will react too slowly based on this earnings slowdown, based on this idea that looking forward, yes, things are slowing, inflation is slowing, but earnings are slowing as well. The third and final topic I want individual investors to focus on before they make their investment decisions, and I have a number of charts to illustrate this point, is looking at investment in different ways. And as I said off the top of the show, I always talk about being a contrarian investor. I think that's the best way to make money and to grow your wealth. Be greedy when those are fearful, fearful when those are greedy. A famous Warren Buffett saying, you want to buy low to sell high, buy weakness, sell into strength. But if you have kept with that idea, our first chart shows that probably wouldn't fly if you're looking at a name like NVIDIA. NVIDIA is a name that has had tremendous success. I remember when this stock was $100 a share, now well over $800 a share, reaching new highs this morning, I believe somewhere in the 885 range. And this is a name that you would say, as a contrarian, well, it's gone up, so we probably want to sell it and take our profits to buy something that is perhaps hasn't gone up as yet. However, if you look at this from a GARP approach, growth at a reasonable price, you're going to notice that NVIDIA today, trading at about a 35 times forward earning multiple, is actually cheaper today than it was a year or two ago when it was trading at well over 40, 50 times earnings. So if you are somewhat of a value investor, a GARP investor, growth at a reasonable price type of investor, you're going to say, I want to buy NVIDIA today because it's actually cheaper today than when it had its run or when it's had its run over the past year and a half. It just seems to be getting cheaper. The price isn't keeping up with how fast the earnings are growing. And that's why you want to look at these names. You just can't look at buying cheap stocks because, as we know, sometimes stocks are cheap for a reason. And we call those value traps. And sometimes stocks that appear expensive, they're actually not that expensive. We look at a name like Meta, for example, which is our next chart. Meta trades, I have it here, 25 times forward earnings, not that expensive at all. When you compare it to an AMD, compare it to an Intel, other chip makers, other big cap technology companies, these stocks are trading at well above 25 times. So even other chip makers are more expensive than NVIDIA, trading at 35 times. Meta, or even a Google, trading under 20 times. Big cap tech names that have had tremendous success. And if you were perhaps a contrarian, you might have sold these names to buy some of the cheaper names. I have some examples of some really cheap names that I say are cheap for a reason, that they can't seem to get out of their own way. They can't seem to grow the top and bottom line sufficiently enough to see their stock prices fall. And I point out a couple of auto companies. GM is our first one. GM trades at 4.5 times earnings. 4.5. You compare that to some of the tech names I just mentioned to you in the 20s, and you'd say, sell NVIDIA, sell Meta, buy GM. Well, even though this chart shows you that GM has had a bit of a run recently, if you look back long enough, you can see it really hasn't gone anywhere in the last few years. Ford, another chart we have, would be a very similar type of investment. Again, Ford actually hasn't regained its previous highs that it had a few years back. So if you were a long-term owner of GM or Ford, you probably would be somewhat frustrated that these stocks have not moved nearly as much as some of these high-flying tech stocks. Moving to some of the airlines, Delta Airlines, another name that trading extremely cheap, 6.5 times forward earnings right now. But again, what money would you have made in Delta Airlines? Air Canada, another airline, a chart that is, to me, shows us why those that have owned Air Canada trading at 5 times earnings, why Air Canada stock hasn't moved much. These names are cheap, but in my opinion, cheap for a reason. And the last chart I wanted to show you is a name that I've talked about many times on this show, and that's Bank of Nova Scotia. Bank of Nova Scotia trades at 10 times earnings, so not too cheap, not too expensive from a historical standpoint. Pays you a 6.5% dividend today if you were to buy it. And as you can see here, has shown pretty good growth since the lows at the end of October, beginning of November of last year. And I think a name like Scotiabank, which just reported great earnings, great international growth, great domestic growth here in Canada, I think a name like Scotiabank could be a good idea for those not only looking for growth, but also income, but also looking for a name to own for the long term and maybe even for the short term, as I just think that we are coming off a low in some of these banks like Scotia, and things will just continue to get better. So looking at stocks or looking at investment ideas in different ways, to me, makes a lot of sense for individual investors. And before you make your investment decisions, I think you have to look at not only just the lowest names or the stocks that haven't gone up as yet, but you have to evaluate them from an earnings per share, from a revenue, from a cash flow basis. I think these ways are looking at all the different angles are very important before you make your investment decisions.